This conference will now be recorded.
Good evening, everyone. I am Pete Panito, Business Development Contact for First Northern Credit Union. Tonight, our Director of Sales, David Tognarelli, will present tonight's webinar, 10 Steps to Financial Success. This presentation is part of our weekly financial wellness series in partnership with the City of Evanston. This presentation covers general concepts like cost of credit, diversification, and harnessing the power of time, and then drills down into goals, plans, and investment vehicles. As reference, I included a handout in the email I sent earlier today. If you didn't receive it, let me know in the chat box and I will resend it to you. We will follow up with an email by the end of the week that includes materials that will be presented today. In addition to the partnership we have with the city, First Northern presents free monthly financial wellness webinars as well. If you are interested in that schedule, let me know in the chat box and I will forward that information. Throughout the webinar, if you have any questions, please ask them again in the chat box and David will address them after the presentation. Appreciate you joining us this evening, and with that, I turn the microphone over to David Tognarelli. Take it away, David.
Great. Thank you, Pete. I appreciate the introduction and so happy to be here with everyone tonight in this virtual format as we practice good social distancing. I hope everyone is staying safe and healthy and happy and trying to find ways to keep the time at home occupied, and we're glad that you decided to make this one of those ways. So this workshop tonight on 10 Steps to Financial Success does conclude our April series. And so later this week, you will see an update on our website, fncu.org/Evanston, regarding the new series in May, which is targeted toward the senior population in Evanston. So if you have an older friend or family member or anyone that you're connected with in your network, please encourage them to check out the senior series and an update on the website, fncu.org/Evanston, later this week. So with that, we're going to get started on tonight's webinar, 10 Steps to Financial Success. As Pete mentioned in the introduction, there is a handout that was sent out along with the login instructions that will be referred to several times during the webinar. There's lots of great charts and information for you to complete on your own, and I encourage you to do that after the presentation tonight and reach out to Pete or myself if you have any questions. So, 10 steps to financial success. Financial success means being in control of your money. So tonight we're going to provide an overview of personal financial issues that impact nearly everyone. And learning more about these issues should motivate you to take some positive steps with your personal finances. It's important to keep in mind, though, that financial success is ultimately about being in control over your money. Therefore, income does not necessarily determine success. Rather, choices and priorities do. So here we go. Step number 1 of 10. Step number 1 is establish goals. So the first step is to establish those goals, and to achieve those goals, prioritization is key. This can be done by identifying needs and wants, and then making spending choices with that goal in mind. So necessary expenses that support living, food, water, shelter, clothing, transportation, versus wants, more discretionary, entertainment costs, or eating out, coffee, lunch out, vacations, holidays. Those things are important as well, but more things that we want to budget for and plan for the future, and not be kind of knee-jerk expenses and approaching that way with our goals. So goals need to be specific. Have an achievement date in mind, a specific time period by which you want to achieve the goal. And definitely know how much money can be applied to the goal on a monthly basis. So once you've decided when you want to achieve the financial goal by, you know the total amount, You can simply divide that into the number of months, and you know exactly how much you need to set aside each month to achieve the goal. It's also important that those financial goals are realistic. So the proposed savings amount should be a comfortable figure that fits within your specific budget. And I want to refer the group to, in the handout, the financial goals worksheet on page 1, and encourage you all to complete that after the webinar tonight. It's important to keep in mind when you take a look at the financial goals worksheet that it is broken up into 3 different timelines: short-term goals, which should be achieved within 1 year or less; medium-term goals, which should be achieved within 2 to 5 years; and then long-term goals, which are more 5 years or greater out into the future. Okay, so step number 2 is to take stock. So take stock of what you own and what you owe. Everyone has their own financial starting point, and it's important to determine what that is for you specifically. So some people owe more than they own, and others own more than they owe. So to know the starting point, you can complete a net worth statement, and the calculation is quite simple. It's simply your assets, or what you own, minus your liabilities, or what you owe, and that equals your net worth. So on page 2 of the handout, you'll find a net worth statement, and I encourage everyone to check that out and complete it after the webinar tonight. Step 3, create a spending and savings plan. So step 3, commonly called a budget, we like to call a spending and savings plan. So a spending and savings plan begins by analyzing your income. And in page 3 of the handout, there's a nice little income worksheet that can help you break up your income into monthly figures. So definitely salary, pension, Social Security, things that come in on a regular basis are easily broken into monthly figures, but other things like bonuses, incentives, if you receive gifts at certain points of the year for your birthday or holidays, also income, but should be approached a little differently and broken up based on how much you receive at that point in time into a monthly figure to help you come up with your spending and savings plan. So analyzing expenses comes next. So in order to have accurate figures, you want to track your spending for at least a month. So there's a great expense tracking worksheet, both a weekly version and a monthly version on pages 4 and 5 of the handout that was provided. And in order to know where you are with your spending plan, you need to know where you're spending your money and what you're spending it on and how often. And the only way to do that is to track. So there's a few different kind of methods to the tracking. You could simply keep a log, whether it's a personal notebook or a file on your phone. You can stick to a specific channel of spending, whether it's cash or a specific debit or credit card, always knowing that it's coming out of the same bucket in that way, and then looking back to see where you spent. You could keep receipts and refer back to your receipts in order to know all the things that you spent money on throughout the day, the week, and the month. So you definitely want to be aware of budget busters as you review and analyze your expenses. So these are expenses that can throw a budget off. They include impulse purchases, perhaps splurging on gifts and large luxury items. So that's something you want to try to steer clear of when you're creating your spending and savings plan. Saving is also a key part of the spending and savings plan. So this includes having money set aside in an emergency savings account, but also saving for those financial goals that we talked about at the beginning. Consumer debt is typically very expensive to hold on to, so planning for debt repayment at the same time that you're building your budget and your savings plan is important. And I'd like the group to check out the handout for page 6, an unsecured debt worksheet, just to know where you are with your unsecured debt and kind of coming up with a plan on getting it all paid off. And when we talk about unsecured debt, we're referring to debt not secured by collateral, so a mortgage or a car loan, but rather a personal loan, credit card debt, open-ended revolving lines of credit would be examples of unsecured debt. So in the unsecured debt worksheet, you want to subtract the total of all expenses from the net income amount. Forgive me, this is the bottom line worksheet, which is on page 7 of the handout on the next page. So here we're subtracting the total of all expenses, including your savings and debt payments, from the net income. And this is your bottom line. So the bottom line should be a positive figure. That's the golden rule for any budget. If it isn't, then you want to consider ways to make it so. This can include delaying goals, increasing income if you can find ways to work overtime or extra work, or the easiest way is to simply analyze your expenses and reduce them. So please check out that bottom line worksheet on page 7 of the handout. Moving on, step 4, live within your means. So step 4 is to make a commitment to always live within your means. Consider all the ways that you can prioritize your spending. So most people can't have everything that they want when they want it. So reducing spending in areas that aren't important is one way to prioritize it. You could also substitute expensive items with less expensive items, whether it's grocery store, clothing, other regular items for the household, looking for those less expensive items or coupons or bargains. Postponing certain goals and expenses until they're affordable. So going back to the financial goals we talked about towards the beginning, making sure that they're feasible and they fit within your spending and savings plan. Or perhaps foregoing some expenses altogether if they're simply not affordable. So here is where you might decide to put off a large purchase that isn't a necessary expense, but rather a discretionary one. And then, reward yourself along the way. So always be working towards one thing that you want to save for, one luxury that you're getting excited about in the future, instead of getting overwhelmed and piling up, and really practicing foregoing those big luxury items. Okay, so this is a suggested budget guideline, and it is definitely a general guideline. Every household's net income is going to be different for these exact percentages, but typically we want to keep our housing expense to about 35% of our total net income. So this would be the rent payment, mortgage payment, any upkeep, taxes, insurance on the residence, that sort of thing. Savings should always be at least, if you can, 10% of the total monthly expense from net income. Transportation should be about 15%, so getting to and from work and other destinations. Outstanding consumer debt payments should be no more than 15% of net income, so your total monthly obligations to your creditors should not exceed more than 15% besides your housing payment. And then all the rest, so all those necessary expenses we talked about, food, clothing, entertainment, childcare, medical expenses, contributions, vacations, so saving for a vacation or holidays throughout the year, should be about 25% of your total net income. So again, general guidelines, a starting point, different for everyone, certainly something that you could speak to a financial counselor about. They're available free through our partnership with Balance, provided through the City of Evanston, and also the credit union. We'd be happy to sit down with you and talk about your specific budget and your specific spending and savings plan and guidelines. Okay, step 5, this is so key. So when we talk about saving and fitting it into our budget as an expense, you always want to make it the first priority, and we call that pay yourself first. So this can help you save for goals and financial security. And I always like to say your future self will be so happy that your present self made it a priority and put away the money for a later day. So again, a recommended savings goal is to try your best to set aside at least 10% from net income, but any starting point is great. Really creating the habit of saving is the most important starting point, and then trying to find room in the budget to save more is the next best step. So saving money can be difficult, but you always want to weigh that instant gratification you might get from buying something against the ultimate gratification of achieving those financial goals into the future. So a 3-tiered savings plan. So this goes back to those financial goals that we talked about. Always good to try to keep multiple things in mind at the same time when you're saving. So the first is to establish a liquid savings account, and this is our emergency savings account. So this is our safety net. So the goal for this savings account should equal 3 to 6 months worth of essential living expenses. Although some people may feel more comfortable trying to get up to 6 to 9 months worth of expenses in tougher economic times. So you definitely want to keep this money in a liquid account, like a savings account or a share account at the credit union, and make sure that there are no penalties for early withdrawal. Because if something comes up, an emergency, and you need to get to it, you want to make sure it's easy to access and it's not going to cost you anything. The next tier is for those medium-term goals that you want to achieve within 2 to 5 years. So this could be saving for a down payment on the house, a car, college expenses for a child, and this type of savings plan should be in a semi-liquid account, such as a CD. And that way you're going to get a little bit more return on your investment, but you'll still have a timeline in the medium-term future by which you can access the funds. And then long-term savings plans, savings plan is for such goals as retirement, education, if you have younger children that you're saving for, and this should be invested. And we're going to talk a little bit about those different investment options that are out there. Okay, so the first kind of variable out there for investment options is tax deferred versus tax investments. So tax deferred would be traditional when you're speaking of kind of an IRA or a 401k setup, whereas tax investments would be referred to as Roth. So with a tax investment, the funds would be contributed to the investment plan after they're taxed and then drawn at a later date tax-free, whereas tax deferred would be contributed pre-tax before a tax is applied to them, but then the draw later on down the road would be subject to tax. So this is just a little kind of chart here that shows you over the course of a period of time saving $250 a month in a tax deferred account versus a taxable account. And this growth projection here does assume a 6% annual return and a state and federal marginal tax rate of 30%. So the tax deferred figures are the values in the account, again, that don't reflect the taxes that will have to be paid after the withdrawal. So you don't see the effect there of what you'll have to pay when you draw on those funds later in life. Good to keep in mind. Okay, here's a reminder, and it's so easy to do, right? But quit procrastinating. It's a tongue twister. It's easy, but not wise to put off saving and investing. Start now. Make it a plan. Write it down. Put it in your calendar for tomorrow, on a Post-it note, on your laptop, wherever is going to remind you the most often that it needs to be done. Decide how much to put aside and then have it automatically deducted either from your paycheck into a separate savings account or from your checking account as an automatic transfer on the day that you receive your payroll, and then deposited into a savings or brokerage account. Compounding interest is so key. So when we earn interest upon the interest that was earned previously, and it only works over a period of time. So the sooner we start, the more we can take advantage of that compounding interest effect. Definitely also keep in mind that achieving future goals is often worth spending a little less money today. So foregoing regular coffee trips, regular lunch out, regular, vacations, trips to the movie, foregoing and rewarding yourself on a less regular basis, and keeping in mind the goal for the future. It's gratifying to know that you put in the work and you were disciplined, and down the road it paid off. So don't wait until tomorrow. Start today. So here's an illustration of that. So harnessing the power of time. So here is a chart that reflects a savings plan of $150 a month with a 6% annual return. And you can see the lighter blue bars there on the left is if we start today, after 15, 20, 25, and 30 years. And if we wait 10 years and we put it off, it's much less. So in 30 years' time, we'd only have a little over 60,000 versus, nearly 150,000 if we start today. So $150 a month, starting now, not putting it off, can have that compounding effect, and you're going to save a lot more further down the road. So step 6 is delete your debt. So many people do rely on credit to make ends meet. And if you do, begin to live a cash-only lifestyle. It's the best way to go. It's impossible to get out of debt if you're still relying on debt and charging on a regular basis in order to make your ends meet. Interest and finance fees make debt very expensive. So work with your current creditors to try to reduce the interest rate, perhaps consolidate and get them all into one lower rate loan or a balance transfer to a lower fixed rate credit card. The credit union, definitely an outlet for that. So please inquire, let us know if we can help you out. But paying only the minimum payment on all of your credit card accounts will ultimately just drag the debt out. So you want to also try to do your best to increase the payments to the most you can afford and keep paying until the balance is at zero. And the best strategy to pay that debt off the cheapest or saving the most on the interest is by paying the credit cards with the highest interest rates first, the most to those, the extra all to those. And then when those are repaid, moving on to the next most expensive credit card and so on and so forth in decreasing interest rates. And that's that extra amount that you have to apply. So you want to keep up with all the minimum payments, but aggressively applying any extra amount to the highest interest rate and then working down from there is the best way to get yourself out of debt and delete that debt. Now, it's also good to keep in mind that some debts are okay. So there's definitely okay debt versus bad debt. The okay debt is the good kinds of debt that increase in value. So this would be debt for things like a home, a business, your education. These are investments, right? So they appreciate in the future. And so the debt is good because you're realizing a return on your investment. Whereas bad debt is spent on things that decrease in value. So things like clothes, meals, vacation, things that wear off pretty quickly. You wouldn't want to charge these things, put them on a credit card, and you think you're buying a $50 pair of jeans, and by the time all the interest is paid off, it's a $75 pair of jeans. So keep that in mind when you're thinking about your spending and savings plan and living within your means. So there's a quote here at the bottom: the abuse of credit is a leading cause of financial failure. So do your best to get out of that cycle, live within your means, cash-only lifestyle, and delete that debt. Step 7, buy a home. So become a homeowner. I have great news. Tomorrow night and on Saturday and later on this month, we have some home buying workshops. So we have more information to share with you. Please check out fncu.org/seminars. We'll share all the information we can. We'll have a real estate agent with us tomorrow from the city of Evanston. So please come and learn about how to get on track to buy a home. So a home can be a good investment. Over time, many homes do appreciate in value. As a homeowner, you may be entitled to some tax breaks. So definitely consult with your tax advisor. Find out if there's some deductions out there based on being a homeowner. But it's never too early to start planning. So most lenders do require a down payment to get a mortgage, especially one with a low interest rate. And it's also important to have a good credit score. So please come to our home buying webinar tomorrow night, Saturday at 10, and learn more about the process of getting prepared to buy a home. We'd love to share that information with you. Step 8 is to diversify your investment portfolio. So it's step 8 for a reason. This comes after the other steps when we're talking about the emergency savings plan and financial goals and setting up a budget. And once you get to a point where you're looking at stocks and bonds and cash, you want to make sure that you're diversifying those things. So with each investment, there's going to be risk involved. Always want to weigh the potential for risk against the potential for return. And through diversification, you can hedge that risk by having a mix of stocks, bonds, and cash offers. You can have both growth and security at the same time. So stocks, just brief overview, share of stock represents ownership, interest in a company. You buy shares with the assumption that they'll increase in value, and then you sell them hopefully at a later date for a higher price. Bonds is literally a loan that you're making to a company or government. You buy them for a promised rate of return, and then you receive those income payments over time. And then cash is just that. Cash equivalents, very low risk. Those are things like CDs, treasury bills through the government. And so you want to make sure that when you look at your portfolio with your financial advisor, that you look at diversifying these things and making sure that you're hedging the risk across these various investment options. An easy way to do that is mutual funds. So mutual funds instantly diversify. So these companies that offer mutual funds purchase a mix of stocks, bonds, cash equivalents, and then sell the shares of that mix to the public. So the diversification is built right in. Okay, so we talked about the risk a little bit, and this gives you an idea of the return from 1926 through 2014. So over time, obviously, stocks have provided the highest rate of return, then bonds, and then cash. The return is high over a long period of time for stocks, but there's also much larger hills and valleys than you're going to get on bonds and certainly on cash. So this data here is based on S&P 500 index for stocks, aggregate indexes for bonds, and the 30-day U.S. Treasury bill for cash. Step 9 is to plan ahead. So we're talking about protection, we're talking about insurance. So you definitely want to take a look and take stock of the various types of insurance necessary and available to you. So health insurance for your medical expenses, definitely considering disability insurance, which is going to protect your income if you can't work due to illness or injury. So a lot of us may have it provided through our employer. Definitely is going to be a portion of your pay, could be some increased expenses, and then it doesn't travel with you if you gain new employment. So looking at those other disability insurance options out there to protect you no matter what, good to keep in mind. Then life insurance protects your loved ones with income replacement if you pass, and definitely want to make sure that family dependents are taken care of into the future if that does come up. Liability insurance protects you from financial loss due to a lawsuit against you. So this is going to be a little bit more appropriate for homeowners, business owners, where someone's coming into your residence or business place of business, and if they have an accident, you want to make sure that you're protected against any lawsuit. Then auto insurance, of course, a minimum of auto insurance is mandatory by state law, but you might want to add to that for greater protection. And then if you have a loan against your vehicle, there's increased requirements for auto insurance. Renter's insurance protects your personal property against fire, theft, or other loss if you're a renter. And then homeowner's insurance is required if you have a mortgage, but even if you don't, definitely important because your home is probably your most expensive and precious asset. So you want to take stock of all your insurance needs, speak with an insurance agent, shop around, compare and contrast both the protection and the service and the cost, and make sure that you weigh all the benefits across those different categories and make good decisions about your insurance coverage. There's a part 2 of step 9, and that's estate planning. So definitely want to keep in mind a will and having a formal will drawn up. You can do this yourself, or there's some software programs out there, or you can contract a lawyer to do it for you. So when you draw up a will, you want to determine your executor. This is going to be the person who administers the estate and distributes your assets. Then you want to decide the distribution, so who will get what, and alternative beneficiaries if your first choices are no longer living. Choosing a guardian for your children. If you don't decide that and have it written in a will, the state will decide for you. So definitely an important reason to take that step. And then including a residuary clause to cover any leftovers of your estate that you didn't explicitly mention. So then there's also trust, and when you form a trust, you essentially transfer the asset to another person, the trustee. The trustee will then manage and control this asset for the benefit of a third party. So a trust can ensure that the people you love are provided with an income stream after you die, and then also protect the money in your estate from taxation. So if your estate is large, a trust can definitely be a good idea, definitely for the protection reason, but also to care for loved ones. And then also just documenting wishes for life-saving measures so that your loved ones know what you want to have happen if you become incapable of making those decisions. So making sure that there's someone kind of waiting in the wings and can help you make those decisions if you're unable to. And I know that discussing these matters can be difficult, uncomfortable, but definitely I want to urge the group to just think about planning for crisis and death. There's satisfaction in knowing that your loved ones are protected and that there's a plan if something unforeseen happens. Okay, we're nearing the end. So step 10 is get help. So professional assistance is a good idea for important money matters. And we're here for you, your credit union, First Northern, here in the community. So please come to us. Let us know. There's no obligation. If you want to sit down with one of our financial service advisors, we can talk about many of these items covered today. There's also information that will be shared with you following the presentation regarding our partnership with Balance. Free financial counselors available through them who can help you with a budget, review your credit report, talk about your future financial goals. Then financial planners can help you create a comprehensive financial plan, and they'll usually offer to sell you investment and insurance products. So check out some options out there for financial planners. And then estate planners are usually lawyers, and they can ensure that your financial wishes are met. You can also learn on your own. So you can check out the internet. There's many excellent free resources out there through our website, through the partnership with the City of Evanston at evanston.balancepro.org, and we'll share that with you following the webinar tonight as well. Lots of great information, podcasts, videos, calculators, articles, all things that you might want to learn about relating to your finances. Then please join us for more workshops and seminars, currently in webinar format. So through our partnership with the city every Wednesday at 5:30, but then also check out our monthly workshop series at fncu.org/seminars. And finally, there's many authors out there for financial planning. There's magazines related to financial planning. So go out, check out a book, get a good read, and gain from someone else's perspective. Okay, so we always like to end with a quote. So Ben Franklin says, an investment in knowledge always pays the best interest. So, arm yourself with knowledge about your finances, and that way you can get on the road to financial success with the 10 steps that we've talked about tonight. So it's not difficult. There's a lot of concepts here that we talked about. It just takes a bit of learning and dedication, and we're here to help. So please don't hesitate to reach out.
Okay, great. David, there are a few questions. So let me just read them directly to you, okay? And you can answer them. One is real simple. How low are mortgage rates right now?
Great question. So if that is your specific question, I'm sure Pete has your information, and we will get you in touch with Sandy Federici, our mortgage loan officer. There are a lot of qualifiers in order to know your specific situation, what your mortgage rate would be, but they're low. I can say that. We've been busy with requests for refinances, and people are looking to lower their interest rate right now. So they're lower than they have been, and we would love to share a personal interest rate quote with you, and I'm sure Pete will get your information, and we'll get that information out to you.
Okay, great. I've gotten. I'll send out an email. The next question, are CDs or U.S. bonds the safest investment, or is a mutual fund safer?
Mutual fund is going to have a little bit more risk built into it, depending on the level of diversification of the bonds and stocks, whereas CDs, typically offered through a financial institution and insured through either the FDIC or the NCUA, and U.S. Treasury bills are almost guaranteed. So much safer on the U.S. Treasury bills and CD side, a little bit of a risk of investment, principal investment on the mutual fund side, depending on, again, the level of stock mix and bond mix in the portfolio.
Perfect. Okay, I have a question regarding paying off a lot of debt. Getting a home line of credit, is that a common option people choose, or is that a definite last option?
It's a great option. So there can be some significant savings that come with either a home equity loan or a home equity line of credit, just based on the pure fact that it is a secured loan. You're going to get a much lower interest rate. Everything's going to be consolidated into one place, and it's a great option for those folks that have the equity. For those two reasons alone, I've seen and I've personally worked with people where we've increased cash flow as much as $500 a month, even up closer to $1,000 a month, and then really putting people on a plan, whether it's 5, 10, or 15 years, to getting that debt paid off. Depending on the total amount of debt, it's going to range for some folks, but it's a much lower rate, everything consolidated into one place, easy to automate the payment. And then, the key to that is once you've consolidated all the debts and moved it into a lower fixed rate home equity loan type option, is putting those credit cards away, living the cash lifestyle, making sure that your income exceeds your expenses, and making sure that you stay on that track.
Okay, great. And just one last question. Are IRAs for people to open up personally, and 401ks, that's strictly for employers to open up on behalf of employees?
Great question. So 401k is a group plan provided through your employer. And if you have specific questions about your 401k plan, I would encourage you to reach out to your HR or benefits representative at your place of employment. So there's some benefits that come along with having a group plan and the different investment options that are available. Whereas an IRA is just that. It's an individual retirement account. So it is something that you do yourself, and you work with the financial institution that offers the IRA to choose what type of investment option you want to put those funds into.
Okay, perfect. And that was the last question. So I want to thank everyone for joining us. And as David mentioned, we have a home buying webinar tomorrow evening at 5:30. If you'd like to join us, let me know by way of email, and I will send you the login information for tomorrow night. We do begin a new series of weekly webinars starting next week in partnership with the City of Evanston for the month of May. And I will send everyone an email tomorrow with materials that we addressed today. And with that, unless David, you'd like to add a few closing comments, I want to wish everyone positive energy, stay safe, and stay healthy.
I'll echo what Pete said. Stay safe, stay healthy, stay positive, and we hope to see you at a future webinar presentation and one-day workshops in person as well. Have a great